Hey everyone, and welcome back to The Explainer. Today we're digging into what is easily one of the most fascinating corporate stories of the entire year. We're going to break down Microsoft's absolutely mind-blowing recent quarterly performance. But, we're not just going to skim the headlines here. We're going to actually map out the hidden strategic maneuvers, the massive investments, and frankly, the really painful trade-offs happening behind the scenes. Because right now, this is a company walking a literal trillion-dollar tightrope.
To really ground ourselves in the sheer scale of what we're looking at, $450 billion. Following their latest earnings report, Microsoft added that historic amount to its market value in a single day, a 16% stock surge, which is their biggest one-day gain since way back in October 2008. I mean, to put that into perspective for you, they added more value in one single trading session than the entire gross domestic product of countries like South Africa, Turkey, or Finland. Just incredible. So you've got to ask yourself, how exactly do you add nearly $500 billion in value in just 24 hours? Okay, let's dive right into this. Because it's not magic, right? It is a highly complex, incredibly aggressive strategy driven by massive bets on artificial intelligence, a literal race to build custom computer chips, and, surprisingly, a series of very painful internal layoffs. Section 1. The boom. Q4 2026 earnings. All right, so looking at the numbers, Microsoft comfortably beat consensus estimates across the board. They reported $90 billion in revenue. That's an 18% increase year over year, which easily cleared the $87.7 billion estimate. And adjusted earnings? Those came in at $4.81 per share, completely smashing the $4.25 expectation. All of this performance ended up pushing their full fiscal year 2026 revenue to a staggering $331.8 billion. But, the real star of the show here, the true engine driving this boom, is absolutely their cloud platform. Azure saw a 43% year-over-year surge, and that pushed it past $100 billion in annual revenue for the very first time. This just brilliantly illustrates Microsoft's sheer dominance in the cloud computing space right now. It's actually their fastest growth in this sector since early 2022. And honestly, they don't expect this train to slow down anytime soon. On the earnings call, CEO Satya Nadella pointed this out, saying demand for Azure and AI services continues to exceed available capacity. Because of that relentless, seemingly bottomless demand, management is confidently guiding for another 45% growth in Azure for the current quarter. They literally cannot build the data centers fast enough to give customers what they want. Section 2. The big bet and the hidden risk. $175 billion on AI. So let's talk about what it costs to fuel all this momentum. Microsoft spent $41 billion on capital projects in the fourth quarter alone, and they've committed approximately $175 billion for calendar year 2026 just to build AI data centers and buy semiconductors. That is a huge number, but this massive investment is already paying off. Microsoft 365 Copilot now has 30 million paid seats, which jumped from 20 million in just 3 months. To give you an idea of the scale of these enterprise deployments, NHS England is rolling out over 500,000 seats after a trial showed it saved staff about 43 minutes a day. You've got KPMG buying 276,000 seats, HSBC taking 200,000. The enterprise world is adopting this tech at lightning speed. But amidst all that crazy success, there's a really fascinating caveat. $24.1 billion. That is exactly how much revenue came directly from OpenAI in the fiscal year ending in June. When you actually peel back the onion on this, a hidden vulnerability starts to emerge. That $24.1 billion, that represents roughly 70% of Microsoft's total AI sales. So the really crucial takeaway here is that while Microsoft is out there spending $175 billion on infrastructure, an overwhelming majority of the AI revenue they are currently generating relies heavily on just a single, very close partner. OpenAI pays Microsoft for computing power, and they share revenue. But man, that is a massive, massive concentration of risk. Section 3, the trade-off, restructuring Xbox. Now, on one hand, you have this $175 billion commitment to AI infrastructure. But on the other hand, Microsoft is simultaneously cutting 4,800 jobs. That is roughly 2.1% of its entire global workforce. You might be wondering, why on earth is a company making record profits laying off thousands of people? Well, analysts are quick to point out that this massive AI spending has to be offset somewhere. It's a pretty brutal reallocation of capital. And right now, the gaming division is bearing the absolute brunt of this portfolio shift. Even after their blockbuster acquisition of Activision Blizzard, Xbox is going through what its leadership is calling its most significant restructuring in history. 1,600 roles were eliminated immediately, and there are another 1,600 cuts expected through fiscal year 2027. On top of that, 4 development studios are being spun off as Microsoft shifts its whole strategy away from console-exclusive titles toward a multi-platform approach, mostly to better compete with Sony and Nintendo. Of course, this naturally brings up the elephant in the room, right? Is artificial intelligence taking these jobs? Well, internal communications actually address this directly. In a memo to employees, Chief People Officer Amy Coleman stated, "The roles eliminated today are not being replaced by AI. What is true is that AI is changing how work gets done. So what we're seeing is an objective, massive shift in corporate priorities, essentially funding the future of AI by streamlining their legacy divisions." Section 4. The Independence Play Maya 300 Strategy. To really understand why this hardware independence is an absolute necessity, you have to consider this incredibly dramatic leaked email from CEO Satya Nadella back in 2022. He wrote, "We're now just a thin layer on top of NVIDIA, and all the intellectual property is in OpenAI's hands." In that very same communication, he warned that one of their business units was going to lose $4 billion in the following year, entirely because of the staggering cost of running AI models on hardware they simply didn't control. They realized right then and there they had to build their own chips. And this realization has built into a really aggressive hardware timeline. Step 1. Microsoft plans to unveil its next-generation Maya 300 AI chip this fall, likely around September. Step 2. They're already in talks with TSMC to secure production capacity for 300,000 of these chips for delivery in 2027. And finally, Step 3. Their long-term goal is to scale that overall production capacity to over 1 million units. Make no mistake, this is a huge leap. I mean, their previous generation, the Maya 200, only saw tens of thousands of units produced.
The main reason they're pushing this so incredibly hard comes down to efficiency. Internal testing shows that even their older Maya 20 chip already delivers 30% better performance per dollar when compared to existing hardware from NVIDIA. That kind of cost advantage is absolutely crucial for Microsoft, especially since they're currently playing catch-up with Google's TPU and Amazon's Trainium chips in this escalating custom silicon war. The Maya 300 is really their big play for total hardware independence.
Section 5. The Double-Edged Sword, Security Paradox. 400. That is the historic number of security flaws Microsoft had to address in their August 2026 Patch Tuesday update. This massive, unprecedented update included 42 critical vulnerabilities and 3 zero days, one of which, by the way, was actively being exploited. But here is where we hit a really fascinating paradox. Why were there so many flaws found all at once? Well, Microsoft recently implemented an AI-powered vulnerability discovery system. It's an internal tool that automatically hunts down previously hidden security flaws inside their own code. So on one hand, AI is giving Microsoft much better security by finding all these bugs that human reviewers missed. But on the flip side, it creates massively heavy workloads for their IT teams globally who suddenly have to rush to deploy huge patches to fix hundreds of newly discovered vulnerabilities all at once. It is quite the side effect of the AI revolution. So bringing all these narrative threats together, the record revenues, the $175 billion AI bets, the painful layoffs, the custom chips, and this whole security paradox, what is the market's ultimate conclusion on this high-wire balancing act? Section 6. The Bottom Line, Wall Street's Verdict. Well, it turns out analysts remain incredibly bullish on Microsoft's long-term play. Despite the short-term profit margin squeezes from all that aggressive AI spending, and despite the glaring concentration risk with OpenAI, Wall Street is fully on board. Bernstein actually raised its price target to $660, which is a 32% upside from recent levels. And CLSA set an even more ambitious target of $700. They firmly believe this massive upfront spending is ultimately going to pay off big time. But I want to leave you with this provocative thought from Bernstein analyst Mark Mowardler. He noted, the central question for investors has shifted from how much Microsoft will spend to how much revenue and profit that spending can generate. As Microsoft gambles hundreds of billions of dollars, completely reshapes its workforce, and races to build its own silicon, the answer to that question won't just define Microsoft's future. It's going to define the entire trajectory of the global AI industry. Thanks so much for joining me for this explainer, and definitely keep your eyes on those numbers.